Hello friends, welcome back to the second video of our mock test series. In this video, we will cover module B of Principles and Practices of Banking paper, which is Functions of Banks. Friends, again, this is a very important module of this paper and you must pay special attention to all the questions which we are going to discuss in this mock test. As usual, I will cover conceptual case study based questions only since this is a new pattern of JAIIB. They no longer ask simple fact based questions. They will in fact check your concept clarity in each and every question which they ask in examination. But before we start, don't forget to get your JAIIB Masters Pack from the links given in description of this video. Now this is a pack of 4 Power Pack books. All these are 1000 series question banks of IE, IFS paper, Principles paper, Accounting paper and Retail Banking and Wealth Management paper. Now all these books contain super special 1000 plus questions which are very important for your examination. All the books contains real exam level questions and that too with updated difficulty level. These are chapter wise question banks, so it's easier for you to finish this in a step by step manner. Not only this, these question banks comes with lots of case studies and numericals and that too with detailed solutions. And the best part of this is that you get my full support with respect to any problem or issue you may face in these question banks. All the links are there in description of this video, so don't miss out on these amazing books. So let's start with today's mock test. And the first question is from chapter 22, that is Principles of Lending, different types of borrowers and types of credit facilities. And the question goes like this. Coromandel City Urban Bank is considering a loan application from Mrs. Neha Gupta, a married woman who intends to use the funds for starting a home-based business. The credit officer is uncertain whether to involve Mr. Gupta, her husband, as a co-borrower or guarantor. Which of the following would be most appropriate approach for the bank to handle this application? And the options given are these. And the first option is sanction the loan solely in Mrs. Neha Gupta's name, provided she has an independent source of income and meets repayment capacity norms. Then second option B is involve Mr. Gupta as mandatory co-borrower because the loan is being used for business purposes. Then third option C is decline the application as the husband's liability cannot be established. And last option D is require Mr. Gupta to provide collateral in his name, ensuring his involvement in case of default. Now friends, please note under Indian law, a married woman is not restricted from borrowing. She should be treated as an independent borrower provided she has an income source and the ability to repay. Also note her husband's involvement is not mandatory unless he voluntarily joins as a co-borrower or guarantor. Therefore, the bank can sanction loan in Mrs. Gupta's name alone if she meets the criteria. Thus, the correct option for the given question is option A. The next question is also from chapter 22, that is Principles of Lending, different types of borrowers and types of credit facilities. And the question goes like this. Balasore Urban Bank is evaluating the loan applications of 3 borrowers. First one is Mr. Verma, a sole proprietor of a manufacturing unit. Then second is Krishna Traders, a registered partnership firm with 3 equal partners. And lastly, third is Omega Limited, a company incorporated under Companies Act 2013. The bank's credit committee wants to analyze the legal and financial liabilities associated with each types of entity in the event of a default. Which of the following correctly outlines the liability structure and recourse action for the bank in these cases? And the options given are these. Now option A says, for Mr. Verma, the bank has recourse only against the business assets. Then for Krishna Traders, the bank has recourse against the firm's asset but not personal assets. And lastly, for Omega Limited, the bank has recourse against the company's assets and director's personal assets. Then second option B says, for Mr. Verma, the bank has recourse against both personal and business assets. Then for Krishna Traders, the bank has recourse against the firm's asset as well as personal assets of the partners. And lastly, for Omega Limited, the bank's recourse is limited to company's assets only. Then option C says, for Mr. Verma, the bank's recourse is limited to his personal assets. Then next for Krishna Traders, the bank has recourse only against the firm's registered capital. And lastly, for Omega Limited, the bank can pursue any asset owned by the company's shareholders. Then last option D says for Mr. Verma, the bank can seize only machinery and equipment. Then for Krishna Traders, the bank must pursue legal action separately against each partner. And lastly, for Omega Limited, the bank must obtain a special court order to recover dues from any assets. Now friends, please note, when lending to different business entities, the extent of liability and recourse available to the lender varies significantly depending on the legal structure of the borrower. First, in case of proprietorship firm, the owner, that is proprietor, is personally liable for all business debts. And there is no distinction between business assets and owner's personal assets. So friends, this means that if Mr. Verma defaults, the Balasore Urban Bank can initiate legal proceedings to claim both his personal as well as business assets to recover the loan amount. Then second, in case for partnership firm such as Krishna Traders, each partner has joint and several liability under the Indian Partnership Act 1932. Now this implies that if the firm defaults and its assets are insufficient to recover the dues, then bank can hold any or all partners responsible for entire debt amount. Thus, the bank has right to pursue individual partners' personal assets for full recovery. Lastly, for a company like Omega Limited, the liability of shareholders is limited to their shareholding. And this is because the company is considered a separate legal entity under Companies Act 2013. Friends, this separation means that bank can only claim the assets of the company itself. But shareholders or directors' personal assets cannot be touched unless they have provided explicit personal guarantee or engagement in fraudulent conduct. So I hope by now you can easily answer the correct option, which is option B. The next question is again from chapter 22, that is Principles of Lending, different types of borrowers and types of credit facilities. And the question goes like this. West Bangla Urban Bank has received a loan application from Mrs. Aisha Khan, a Pardanashin woman, for an education loan for her daughter. During the documentation process, the bank noticed that Mrs. Khan was represented by a third party throughout the loan application, and her personal identification was not physically verified by the branch staff. Despite this, the bank sanctioned the loan and disbursed the funds. 6 months later, Mrs. Aisha Khan's husband disputes the loan, claiming that Mrs. Khan never applied for or authorized the loan and that the contract is invalid due to undue influence and misrepresentation. What would be the most likely outcome in this scenario under Indian banking and contract laws? And these options are given to you. That is, first option is, the loan will be considered invalid if Mrs. Khan can prove undue influence and lack of understanding, and the bank may face legal liabilities. The next option B is, the bank can argue that it was Mrs. Khan's responsibility to verify the documents, making the loan enforceable. The next option C is, the loan is valid as long as bank obtained her thumb impression even if her identity was not physically verified. And last option D is, the contract is enforceable because Pardanashin women are not given any special protection under Indian Contract Act. Now friends, please note, Pardanashin women are given special protection under Indian law to prevent undue influence and fraudulent transactions. According to legal proceedings, any contract entered into with a Pardanashin woman must be thoroughly verified to ensure that she understood the transaction and voluntarily consented to it. This means that the bank must exercise extra caution, such as confirming her identity in person, explaining the nature and implications of the contract, and ensuring her ability to make informed decisions without external pressure. Additionally, independent third-party verification is crucial to avoid potential disputes about the contract validity. Now friends, in our case, since Mrs. Khan was not physically identified by the branch staff and relied on a third party during the entire transaction, it opens up possibilities for claim of undue influence and misrepresentation. Her husband can successfully challenge the validity of the loan by establishing that Mrs. Khan did not fully understand the contract or that her contract was obtained improperly. As a result, the bank's position is legally weak here, and it may face difficulties in recovering the loan amount. The contract should be declared void, making it unforeseeable, and this exposes the bank to potential legal and reputational risk. So, as far as this case goes, the correct option is option A. Now, before moving ahead, don't forget to subscribe this channel since this is the only channel that provides quality content. Also join my Facebook and Telegram groups where I post lots of one-pagers, mock questions and other useful stuff which is very important for your examination. You can also join my Telegram channel and connect me on my LinkedIn profile as well. All the links to join are there in description of this video, so do join after you finish this lecture. The next question is from chapter 32, that is letter of credit. And the case study, or it is in fact a numerical, and it goes like this. A mid-sized manufacturing company, that is Uttar Kannada Glass Limited, plans to secure its letter of credit facility from its bank for sourcing raw materials to meet its annual production needs. The company has provided the bank with following financial data. That is, first is total raw material consumption, that is projected value for the year is rupees 5,400 lakhs. Then percentage of purchases on credit, which is out of total raw material consumption, is 60%. Then time taken for the bank to issue and advise LC to the supplier is 8 days. The next time taken for the shipment of material and their transit to Uttar Kannada Glass Limited's warehouse is 22 days. The next is credit period agreed between the seller and the company is 40 days. Then next, the bank's internal policy for calculating LC limit states that the limit should be equal to maximum value of LCs per cycle. And lastly, we have to assume 360 days in a year for calculation purposes. Now, based on the above information, calculate the optimal LC limit for Uttar Kannada Glass Limited for one complete cycle and determine the minimum LC limit that bank should approve. And the options given are these. Now friends, this is a very important numerical from this chapter. So let's see how to find LC limit. So first, let's determine the projected value of purchases on credit, which will be 60% of rupees 5,400 lakhs, which equals to rupees 3,240 lakhs. Next, let's calculate the time taken for one cycle of LC operation, which will be time for issuing LC plus shipment and transit period plus credit period, which equals 8 days plus 22 days plus 40 days equals 70 days. So the number of LC cycles in a year will be simply 360 divided by 70 days per cycles equals to 5.14 cycles. Thus the value of LC per cycle will be simply 3,240 lakhs divided by 5.14 equals 630.35 lakhs. I hope you got the explanation here. Thus the correct option for the given question is option D. The next question is also a very important numerical from chapter 25, which is types of collaterals and their characteristics. And the question goes like this. A bank is evaluating a loan application for an advance against gold ornaments valued at rupees 12 lakhs for a small business owner. The jewelry consists of 150 grams of gold, out of which 60 grams is of 18 karat purity and remaining 90 grams is of 22 karat purity. The bank's policy mandates maximum loan to value, that is LTV ratio of 70% for business loans, and the RBI guideline specifies a 75% maximum LTV. The average price of 22 karat gold for last 30 days as quoted by Indian Bullion and Jewelry Association Limited is rupees 5,000 per gram. Now calculate the maximum loan amount the bank can grant under its internal policy, assuming it adheres to lower LTV ratio. And these options are given to you. Now friends, as you can see, this is also a very important numerical. So let's see how to arrive at the correct loan amount. Friends, first we need to determine the 22 karat equivalent value of this gold jewelry. Now gold purity is measured in carats, where 22 karat is considered the standard for most jewelry purposes. Now in the given question, the jewelry consists of two purities. 60 grams is of 18 karat gold and 90 grams is of 22 karat gold. Now friends, since the value of the gold loans is generally standardized to 22 karat gold purity, we need to convert this 18 karat weight into 22 karat equivalent using the formula 22 karat equivalent weight for 18 karat gold equals weight of 18 karat gold multiplied by 18 divided by 22, which equals 60 multiplied by 18 divided by 22 equals 49.09 grams. Then next is 90 gram of 22 karat gold does not need any conversion as it is already in desired purity. So total 22 karat equivalent weight equals 49.09 plus 90 equals So total 22 carat equivalent weight will be simply 49.09 plus 90 equals 139.09 grams. Then next we have to calculate the market value of this 22 carat gold equivalent. Friends, the average price of 22 carat gold for the last 30 years as given in the question is rupees 5,000 per gram. So market value will be simply total 22 carat equivalent weight multiplied by price per gram, which equals 139.09 multiplied by 5,000 equals rupees 6,95,450. I hope the explanation is clear up to here. Now friends, this is the total market value for the jewelry after converting to 22 carats gold equivalent, and this serves as the basis for calculating the loan amount. Lastly, we will calculate the maximum loan amount under bank's internal policy. Now, as given in the question, the bank's internal policy mandates a maximum LTV ratio of 70% for loans against gold for business purposes, which is in fact stricter than RBI's maximum of 75% LTV. So, maximum loan amount will be simply market value multiplied by LTV ratio, which equals rupees 6,95,450 multiplied by 0.70 equals rupees 4,86,815. So friends, this value indicates the maximum amount the bank lend against the pledged gold under its own internal policy, which is considering stipulated LTV ratio. Hence, the correct option for the given question is option A. Next friends, if you are enjoying the content and found it useful till now, then don't miss to like this video, since this tells me that you are loving the content and it also motivates me to make more such awesome content. I would love to connect with you all on my LinkedIn profile as well. You can connect with me from the link provided in description of this video. Next, let's move forward with our mock test. The next question is from chapter 27, that is types of collaterals and their characteristics. And the question goes like this. A mid-sized bank in India has recently entered into a series of transactions involving derivative instruments like forward contracts, promissory notes, and bills of exchange with both domestic and international counterparties. The bank's compliance team needs to ensure that all the instruments are properly stamped and legally valid. During a routine audit, they discovered that a promissory note executed in London was stamped and presented to the bank's headquarters in India after 6 months of its issuance. The auditor highlighted this as a violation of Indian Stamp Act 1899. What is the appropriate course of action for the bank to legally rectify this issue, and what are the potential consequences if the issue is not addressed? And these options are given to you. That is, first option is the bank must cancel the note and reissue it with correct stamping, otherwise the note will be treated as null and void. Then second option B is the bank can pay a penalty equal to 5 times the deficient stamp duty within 3 months to validate the note. Then third option C is the bank can regularize the note by paying the deficient duty and penalty equal to 10 times the applicable duty, allowing it to be admitted in evidence. And last option D is the bank must seek approval from a judicial authority to validate the promissory note through a special notarization process. Now friends, please note the Indian Stamp Act 1899 is a comprehensive legislation that governs the imposition of stamp duties on various instruments. Then as per section 35, any instrument that is not duly stamped is inadmissible in court as evidence unless it is regularized by paying the deficient stamp duty along with the penalty. Now please note here the penalty is calculated as a greater of 5 rupees or 10 times the deficient duty amount. This rule applies to instruments such as promissory notes and bills of exchange that are either unstamped or completely unstamped when presented in India after being executed outside the country. Now in the given case scenario, the promissory note executed in London should have been stamped in India within 3 months of its first receipt in India, which is prescribed under section 18. But in our case, since this requirement was not fulfilled on time, the document is currently deemed invalid for evidential purposes unless the bank pays appropriate penalty to regularize it. Also note here that reissuing a new promissory note is not a viable solution as it would complicate the legal validity of original transaction. Not only this, there is no need to seek judicial intervention as the Stamp Act provides a clear procedure for rectification. Please note timely correction is crucial to preserve the document's enforceability, as an unstamped note can hinder the bank's position in any future litigation. So as far as this question goes, the correct option is option C. The next question is from chapter 31, that is contracts of guarantee and bank guarantee. And the question is, a multinational manufacturing firm operating in India entered into a contract with a local contractor for building a factory with a bank guarantee of Rs 50 crores provided as security for the release of advance funds. The contractor approached its bank for the issuance of the guarantee specifically for the mobilization of advance of Rs 50 crores. However, due to a miscommunication between a bank's front office and legal team, a standard performance guarantee template was used, including additional clauses covering the entire performance of the contract. After 6 months, the contractor completed the mobilization stage and repaid the full advance amount. But the beneficiary invoked the guarantee, citing delay in project timelines, and demanded Rs 50 crores as damages for non-performance. If the bank makes the payment as demanded, what potential risk and liabilities could arise for the bank, and what would be the recommended action in this case? And these options are given to you. That is, first option is, the bank should make the payment as demanded, as the guarantee document covers performance obligations despite the bank's mistake in using the standard template. Then second option B is, the bank should partially pay the amount equivalent to the mobilization advance and seek to recover any excess from the contractor, as the mistake was not communicated earlier. Then third option C is, the bank should reject the demand for damages, citing special equity and the absence of performance obligations under the originally requested guarantee, and correct the document to reflect the intended purpose. And last option D is, the bank should involve a legal arbitrator to determine the validity of the claim given the dual purpose nature of issued guarantee. Now friends, the correct option for the given question is option C. Now, as given in the question, the bank's error in using a standard performance guarantee template does not justify the beneficiary's demand for payment based on performance-related damages when the guarantee was specifically requested for the mobilization advance. Now, since the mobilization advance has already been paid, invoking the guarantee for damages creates a situation of special equity in favor of the contractor. Thus, the bank should completely reject the demand for damages, as it would otherwise be exposing itself to legal liabilities for negligence and breaching its general duty. And thus, making the payment would in fact result in an unjustified claim against the contractor and potential reputational damage. Friends, lastly, also note options A and B would result in compounding the bank's liability, while option D delays resolution unnecessarily without addressing the fundamental issue. So, I hope the explanation is clear to you. The next question is from chapter 34, that is laws relating to bill finance. And the question goes like this. A manufacturing company, Oro Limited India, receives a demand bill worth Rs 50 lakhs from its supplier and approaches its bank to obtain immediate funds against this bill. The bill is clean and payable on demand. The bank also agrees to provide funding and pays the face value of the bill to Oro Limited. The bank, however, becomes the holder in due course and assumes ownership of the bill. Considering this scenario, which type of financing is being provided by the bank, and what rights does the bank acquire after this transaction? And these options are given to you. And the first option is bills discounting, and the rights acquired are that the bank has the right to sue only the drawee in case of non-payment. Then second option is advance against bill for collection, and the right is the bank must maintain a margin and can cover only the advance amount from Oro India Limited. Then third option C is bill purchase, and the right is the bank has the right to receive the bill amount from the drawee and can also claim additional recovery from Oro India Limited if the drawee defaults. And last option D is drawee bills acceptance, and the right is the bank can recover from the borrower on the due date. Now friends, please note the correct option for the given question is option C, that is bill purchase. Now in a bill purchase transaction, the bank negotiates demand bills, which can be either clean or documentary, and pays the face value of the bill to the holder, making the bank the holder in due course. So this gives the bank full ownership over the bill, including the right to recover from the drawee. And if the DROI defaults, the bank can pursue Oro India Limited for any outstanding amount. Now friends, all this differentiates it from facilities like bill discounting, where rights are limited to the DROI and do not involve the borrower directly once the bank becomes the holder in due course. I hope this explanation is clear to you. The next question is from chapter 34, that is laws relating to bill finance. And the question goes like this. Consider a bank that advances funds against a series of demand bills worth rupees 2 crores 50 lakhs. And this is from a large corporate client. The bank maintains a margin of 15% on such transaction to account for potential fluctuations in payment timelines. However, before the bills are presented for collection, the DROI informs the bank that it can pay only 60% of the total bill value. Assuming the bank decides to liquidate the margin and proceeds to recover the remaining amount from the client, what is the final loss or gain position for the bank? And these options are given to you. Now friends, in the given case scenario, the bank has advanced funds against a series of demand bills worth rupees 2 crores 50 lakhs. Now to safeguard itself against the potential default and fluctuation in payment timelines, the bank maintains a margin of 15% on the transaction. This margin acts as a risk buffer and is calculated as rupees 2 crores 50 lakhs multiplied by 15% equals rupees 37 lakhs 50,000. Friends, effectively this means that the net fund disbursed to the client would be simply 2 crores 50 lakhs minus 37 lakhs 50,000 equals rupees 2 crores 12 lakhs 50,000. Now also note the margin amount is capped as collateral until the bills are fully paid by the DROI. However, in our case, the DROI informs the bank that it can pay only 60% of the total bill value, which amounts to rupees 2 crores 50 lakhs multiplied by 60% equals rupees 1 crores 50 lakhs. So the unpaid amount then becomes rupees 2 crores 50 lakhs minus rupees 1 crores 50 lakhs equals rupees 1 crores. And since the bank has already disbursed rupees 2 crores 12 lakhs 50,000 and it faces a potential loss if it cannot recover from the shortfall. So the bank then liquidates its margin of rupees 37 lakh 50,000, which helps the bank to partially offset the loss. Now after adjusting this margin, the net loss of the bank becomes rupees 1 crore minus rupees 37 lakhs 50,000 equals rupees 62 lakhs 50,000. So friends, this final loss represents the difference between the unpaid portion of the bill and the margin retained by the bank, making it as a crucial risk exposure in such bill finance transactions. Thus the correct option for the given question is option B. Friends, finally we have reached the last question of our mock test, and the question is from chapter 38, that is finance to MFIs co-lending arrangements with NBFCs. And the question goes like this. A large commercial bank is evaluating its credit exposure to various non-banking financial companies, that is NBFCs, engaged in diverse activities. Currently, the bank has provided credit to 3 different NBFCs as outlined below. First one is NBFC A, which is engaged in infrastructure financing with an exposure equals to 15% of bank's tier 1 capital. Then next is NBFC B, which is engaged in equipment leasing and lending activities with an exposure equal to 20% of bank's tier 1 capital. And lastly, NBFC C, which is a group of connected NBFCs primarily involved in lending against gold jewelry with an exposure equal to 10% of bank's tier 1 plus tier 2 capital. If the bank intends to increase its exposure to one of these NBFCs to optimize capital allocation, which of the following strategies would be most compliant with RBI's guidelines on prudential ceilings for NBFCs exposure while still adhering to capital allocation objectives? And these options are given to you. That is, first option is increase exposure to NBFC A by 5% of the bank's tier 1 capital. Then option B says increase exposure to NBFC B by 2% of the bank's tier 1 capital. Then option C says increase exposure to NBFC C by 3% of bank's tier 1 plus tier 2 capital, given that additional lending is also infrastructural financing. And last option D is maintain existing exposure levels for all NBFCs due to prudential ceiling constraints. Now friends, under current RBI guidelines, the exposure to a single NBFC, excluding those involved in gold loans, is capped at 20% of bank's tier 1 capital. Now this means that the bank cannot increase exposure to NBFC-B beyond this current 20% limit. Next, for NBFCs predominantly lending against gold, that is NBFC-C, the maximum possible exposure is 7.5% of bank's Tier 1 plus Tier 2 capital. And this can be extended up to 12% if the funds are on lend to infrastructure sector. And since NBFC-C is already at 10%, an additional 2.5%, which is totaling 12.5%, is permissible if the additional lending is for infrastructure. Friends, please note, increasing exposure to NBFC-A would breach the 20% potential limit. Thus, option C is the only strategy that complies with guidelines and also optimizes capital allocation. So friends, I hope you understood this explanation. So friends, with this I wind up this video. I hope you found the content beneficial. Also, don't miss out to get your JAIIB Masters pack from the links given in description of this video. The combo pack comes with a discount as well. And you can even get individual books as well as online versions. So thank you, and I will meet you again in another video.